Hey everybody, welcome to Trading Capital's daily analysis video. It is currently Friday, June 24th, wrapping off the end of the week. There's lots to discuss. There's still a lot of charts that I'll have to analyze over the weekend, as we have now yet again another weekly candle formation. And as you know, anybody that has studied technical analysis, weekly candlesticks are very, very powerful, and it's another piece to the puzzle in terms of us being able to analyze and getting the most highly probable setup in the near future. So overall, what happened today in the markets? It was a massive broad market rally. Every single sector was up on the day. Realistically, for commodities, the only thing that were down was the likes of like copper, Dr. Copper, lumber. But overall, the sectors, all 11 sectors, were positive on the day. Broker dealers were the ones that essentially were lagging, but they had the strong day the other day. You had the Dow Jones Transportation rocked it today, up 3.96%, and then the real estate home builders and materials, the materials sector was up 3.97%. So an exceptional broad market rally, and this is why we have positioned ourselves to be on the long side of the market. Up until this last week, we were essentially offloading over the last couple of weeks a lot of our shorts. We accumulated longs, and today we offloaded a few of our long positions. So it's constantly this ebb and flow of bouncing back from the long side to the short side and trying to keep a balanced hedge portfolio at the same time is just doing a responsible trading. So while trying to keep a balanced portfolio at the same time, as well as being hedged, is essentially going to put us in the position to continue to print profits in this crazy falling volatile market. So what transpired on the S&P 500 here? You can see here was your open, massive gap up again. Notice how the buying pressure this week, gap up pre-market, gap up pre-market the next day, gap down, gap up. Whenever you start seeing these massive gap ups and gaps down throughout our whole trading week, I start to get some red flags in my mind. It's never a good thing to see every day the markets are either gapping up or gapping down. And now, since we have a gap here at the 377 intraday gap, as well as a gap down here around the 366 mark, it does now have two gaps on the chart that you can argue are pulling you and going to likely pull the price action back down eventually. I still think the markets have more upside, but eventually this market is going lower, and especially when you have gaps on the charts, it's like magnets trying to pull the price action back down, and now you have two of them wielding power. But overall, on a technical basis, you can't take away the rally that happened in the spiders today. Just analyzing this, you had this massive gap up, consolidation in the pre-market, and then you just ripped into the open. And honestly, there was a good 1.5 hours of consolidation here before you started bubbling up, and then it was just a slow grind higher. And one of the reasons why it was a slow grind higher all day is because it was light volume, so you didn't have to have a sharp move. The sharp move was complete in the morning on the heavy volume action, and then it was light volume, which does favor upside in the afternoon, and then eventually you did try to have this short squeeze into the end of the day. So impressive price action for the S&P 500, up over 3.18%, but don't forget these gaps down here. And we were discussing in our previous video yesterday and the day before that we had this some people would argue that it's an inverse head and shoulders. You know, you do have a scenario that you can potentially call this a right shoulder, but the better pattern formation is just your regular cup and handle formation. So you can see this is your cup, your base, flag sideways, and then you broke out. And this was clearly your breakout line over here that we were watching on our previous videos, and you broke out with clear conviction. And the interesting thing is this was your intraday gap fill, and look what you hit. Boom. You had an amazing short opportunity intraday as a day trader to execute and tremendously bank on that trade. So amazing the power of technicals. Notice how this gap was pulling us up there. Now there is still technically on the daily chart one more gap that needs to be filled. So due to the fact that you now have basically 2 gaps to the upside, 2 gaps to the downside. And let's just flip to the daily chart, shall we? So the daily chart is very interesting as well, because look what you finally recaptured. You recaptured this downsloping parallel channel that we were trading in. And now this is where you're starting to run into resistance. This is the ultimate test for the markets as we approach these key areas. But notice how we filled this key gap over here. Let me just move that down over there. And then you'll have one more gap up here, okay, for the markets, which is kind of pulling the price action there now. And then you do have a secondary gap up here. However, I find it very unlikely to ever head to this 427 in the remainder of the year. But certainly this 399 level is the actual calculated upside of that cup and handle formation. So it makes sense that we should continue up in there, but we have had a pretty impressive move off the lows from the 362 all the way up to 390. So that is an exceptional move for the S&P. And since you do have massive daily gaps here on the chart, I do think that there's the potential to at least retrace back to this gap where we broke out before potentially heading higher. So we may see an opportunity as a retrace back to this while you fill this gap, and then potentially a move up. But you don't want to get cute with this market, because the downside is the likely and favorable outcome heading forward. So we just have to generally keep an eye on that. And notice that this sell pressure that happened on this fall and then also on this fall, the sell pressure has always been greater than the buy volume. So just because we've had a late day rally this last week, and that's what we were positioned for, was a technical bounce. The volume and the buy pressure has been extremely light, so it's not to be trusted. It means that smaller money has been buying in and propping this market up, whereas institutional monies are the sellers. So it's smaller monies are the net buyers, institutionals are the sellers. So it is a controlled descent in the S&P 500 right now, and it's truly impressive. But at any point in time, if rates keep continuing, if tensions worsen, if inflation is still peaking, something in the system can break. I still haven't had any signals from the bond market, but nonetheless, those things can change pretty quickly in a day, or let alone a week. So let's just monitor the S&P 500. And I just want to say congratulations for taking profit on ST&E, banked 11.2%. So that is an amazing winner. This week alone, we've banked 9 winners. Last week, we banked 12 winners with 1 loss. So an exceptional 21 wins to basically 21 wins out of 22 trades. So that is an exceptional record over the last 2 weeks. It has been extremely profitable, but at the same time, super exhausting. So I'm going to be taking a break from the crypto market, but I'll discuss a little bit in this video regarding Bitcoin. I'm not going to be taking any trades, but certainly I will put in some levels at what's possibly the outcome could transpire. So the S&P could have more upside, but I'm starting to look more defensive now, because you have 2 gaps to the downside, 2 gaps to the upside, kind of that 50-50 scenario. You could go up, you could go down, but since the breadth and the underlying fundamentals of the market are negative, it does favor a move down at some point. So if we get a push higher, look for me to start unloading our longs. We are in the money with certain trades like Spotify, Alibaba is a beautiful one for us. Walmart we're slightly in the money on Netflix now after today's push. So there's a bunch of Apple trade we're also in the money on. So there's a bunch of longs that we are in the money, and I will be looking to take profits on our financial trade too. ISRG, so Lyft now we're in the money. And notice I did start accumulating more shorts. I do like to be defensive in nature as we close out the quarter. Generally, what happens at the end of the quarter, which is quarter 2 is ending at the end of the month here, generally you can see an influx of money flow into the markets and a lot of money rotation. So there's a lot of names that have been oversold but outperforming, and money rotating potentially out of energies now to pick up some of the under beaten down names. But generally, funds will try to put and pick stocks that are going to be shown on the quarterly statements as performers. So you can see a lot of money rotation into some of the stocks that have had stronger starts to the month, and also closing stronger as money rotates into those positions to make it seem like they've been holding that stock for a fair amount of time when realistically they haven't. They're just trying to impress their investors. So we'll just have to continue to monitor, but I think we're well positioned to weather any outcome here. But let's jump into oil now. Lots to discuss on oil. I'm going to go over the WTI US oil chart as well as the USO chart. And the interesting thing about the WTI here, so US oil, notice how this was your previous resistance, this massive multi-year trend line. And look what you came up. So you had your initial sell-off, bounce, faded again, tried to bounce again, and you're stuck under this trend line. So this trend line was support, and now it's major resistance. So the longer that you start consolidating, and that's what I think we're going to do, is consolidate between this yellow trend line and the bottom of this range, making a beautiful bear flag before breaking lower. So ultimately, I do think that we potentially get some chop and then a move lower. And that is going to be detrimental for the energy bulls because it's been the outperformer of the year so far. It's still the only sector positive, the XLE, but it could change in a heartbeat. And that's certainly what the buying and the distribution volume is telling us over here with these massive inclining sell candles forming. And the interesting thing is if you look at the USO also, just the chart is different, but also now stuck under a major resistance line. So this was your breakout trend line, which you generally get a retrace back to the original breakout zone. You got that retrace, but you could not hold it and collapsed right through that level. And then you tried recapturing it, had a nasty reversal off of it, and you tried recapturing it again today and failed. So there's been now 3 attempts trying to get above this previous support zone, and now it's acting as major resistance. So I do think since you failed on 3 candles, it is definitely showing you that money is distributing into any of the bulls that think they're going to get a technical bounce. I do think it's only a matter of time before you get maybe a couple days of consolidation and then another move down to the 74.50. Eventually you'll consolidate there and then another big move down to this gap fill at 68. So plenty of action in oil. There will be a level where I would consider going long on energies, but it's not there yet. I will certainly keep you abreast of where that level is at that necessary time, and we'll certainly try to accumulate and make a profit on the long side, considering we just got out of the short side. So we'll just have to continue to monitor that as is. Natural gas, discussing natural gas here, you can see that it had a pretty much flat to neutral day, did technically close down on the day on this chart. But overall, if you flip to the 4-hour chart, what is interesting on an intraday basis is this specific bottoming tail on an intraday basis. So what that is identifying to me is on all of these collapses, so this massive collapse, you had no intraday bottoming tail. On this collapse, you had no bottoming tail. On this collapse, you had no bottoming tail. On this collapse, you finally had a bottoming tail. So that is signaling to me that there are buyers, you are at support, there is a big support range here, and that bottoming tail is distinguishing that buyers are stepping in at this level, and obviously we were the ones that covered our shorts, and a lot of people are covering their shorts into this level. But it just shows you that if this level holds, or if it sells off just a touch more, I will potentially look to play the long side. I am looking for potentially one more flush. A pierce of $6 would be nice, so around this 588 level. I would look to start accumulating a small position for a technical bounce. And an interesting thing is if we flip to the weekly chart, one of the reasons I think you have buyers coming in is you have the 25-day short-term moving average on a weekly basis here. So you did not touch that moving average. So I do think it's possible that next week we could see a flush down onto that moving average or just a pierce of that moving average and come into our 580 level here, which I do think will provide an opportunity to at least accumulate for a potential bounce. If it goes lower, our next accumulation will be at 519 and then eventually over here. That would put us in a beautiful position to capture a bounce on natural gas. But again, a lot can transpire. I'm giving these levels now, but it can change from day to day based off of new data, new news. Another LNG terminal could blow up, whatever it may be. These levels are very subjective to change. Let's take a look at gold. I want to do a little bit more of an in-depth analysis. Essentially with gold's price action, let's flip to the daily chart over here. So the daily chart, gold is breaking its key moving averages, but you are still holding this series of basically higher lows. So that's essentially your trend line that you want to watch, and then eventually you do not want to close below this level over here around the 1786. So those are your two key levels of support that we need to hold. Essentially what gold needs to break out of. What's interesting is you are trading in this channel for gold. So this is the interesting range that we're trapped in, and I do think there's a strong potential that we can continue to essentially bounce back and forth in this range before gold is ready to break out. So with this type of pattern, and let me just erase all these lines now. So with this type of pattern on gold, essentially most people would consider this a bear flag, which it technically could be when you have this type of pattern formation. So you could technically consider this a bear flag. And one of the reasons why I'm okay with still trading a pattern that is forming this is simply because monitoring previous cycles. So let's just remove these lines, shall we? So if I take all of those lines away, and if we flip to the weekly chart, and I'm going to discuss this orange line eventually, but it's the US 10-year yield line. But let's just flip to the weekly chart on gold. You can see you're flirting with the 50-day moving average. And essentially what I want to bring to your attention is, so this is the era in 2004 over here where gold had this amazing double top, weekly topping tail. Two exceptional sell signals to potentially short gold, get out of gold. Whenever you enter a double top and a weekly topping tail forms, there's likely downside. And that's what you got. You got 1, 2, 3, 4, 5 weeks of downside, lots of chop. And one could argue this was a bear flag in formation. But notice how you just teetered along that 50-day weekly moving average. And that's kind of what we're doing now. And the important aspect of analyzing the start of this pattern over here is this is where you started in 1996, a massive cup and handle formation. This is a multi-year cup formation. Here's your handle, and then you had your initial breakout, check back, and then you're ripped up higher. And the interesting thing to note is we're forming the same cup and handle formation over the last decade in gold, and we're actually now completing the handle formation. But notice how from this point where gold had your double topping tail, you had 5 weeks of selling and this bearish consolidation along the weekly moving average. Well, it turns out this bearish consolidation just turned into consolidation, and you ended up just floating up, retesting, and chugging along this moving average until you started breaking out. And the interesting thing is when you started breaking out, interest rates, the 10-year, were actually rising in this period. So notice a steady increase in rates doesn't always necessarily mean gold has to sell off. There's a lot of analysts out there that will say when rates rise and in a tightening monetary form, gold is going to sell off. Well, this is not true. The US 10-year yield was rising in a steady fashion over here, just as gold was rising. So it just shows you that there are periods where rates can rally, which is what I think we're in, and gold can also rally. And then the interesting thing to note is this period over here. So you had your double top in interest rates, the US 10-year, in 2006 and 2007, June 2007. And essentially gold started sniffing out something. Something bad was brewing. Gold had this exceptional rally from basically $650 all the way to $1,006. So almost a 40% move in just over a year. And look what interest rates did. Interest rates started to collapse. So this was your first signal, interest rates collapsing deep, all the way from 5.2 6 to basically 3, another 40-50% collapse. So essentially interest rates during this period moved inversely and gold moved up. So there are periods where interest rates and gold move inversely, but there are periods where they also move in tandem. And it's important to try to distinguish what cycle we are currently in. And then when you made a little short-term low and you had interest rates rally, failed rally, you just started having this massive sell-off. But notice how gold was your signal before realistically the markets were collapsing. So the S&P was pretty much starting to fall and make a series of lower lows. But at the same time, you didn't have to partake in the absolute mega crash of rates and the stock market because gold was giving you the signal. You know, gold had a rally as interest rates were declining, and then all of a sudden gold started falling again as interest rates started falling. So it's kind of understanding that 2 points where interest rates will rally up until something breaks in the system, and then that's when they will start falling. And gold will have that initial rally, and then the system or a recession gets really bad or imminent, gold will start selling off, and then rates will collapse even further. And this was obviously the housing crisis where it started basically over here in March of 2008 all the way to December where you had a low in rates. And then when we had a low in rates, rates started rising, but the markets just started ripping, gold started ripping up again. And essentially, you had another sell-off period here where rates started falling drastically. Gold was making a new highs as the lower policy, the loose policy was taking effect. But at some point, that market crash happens where the bond market senses, potentially a big-time market crash, and that's certainly what happened. But essentially, there are major correlations between gold and rates that we have to understand. And I do think we are in a period where gold has had that initial rally. I do think it will hold this level, kind of meandering on the 50-day weekly moving average. And I do think it has the ability to continue to rise and make a push up essentially late into the year as interest rates, as the US 10-year continues to push up. But there's going to be that point where I think where the US 10-year reaches 4%, it will break something. And then it's going to force gold to collapse as well, probably down to the 200-day weekly moving average. So essentially, I do think there's the possibility that gold rallies over the next 3 to 6 months as interest rates rally. And then look for the signal. Look for that hard sell, that technical signal at the top of gold, because you will get some sort of a signal. And essentially, when you get that signal, you know that interest rates are going to start collapsing harder because there's essentially some sort of black swan event that is going to occur. We don't know what it's going to be, what the cause is going to be, but something will occur. So gold is still okay. It's still up on the year considering the indices have been massacred. It's truly exceptional that gold is still positive on the year. I just want to touch base on the website. So essentially on the website, I've posted a couple charts, a little bit of a Netflix technical update, which you can go over on your own terms, but showing you the US dollar here, the DXY chart. So this is a monthly chart where we did some analysis, and essentially when we compare the US dollar, the DXY, which is this top chart, and then this orange line down here, which is the US 10-year yield. So when you have rising yields, which is from this COVID low in 2020, look at the power move that yields have made, interest rates. So this is the bond market pricing in a higher and sharper move in rates. And the beautiful thing is that when you have a move in rates pushing higher, it strengthens the dollars. That is classic quantitative tightening policy effects. And the orange line at the bottom has clearly broken out to the upside. And generally what you will get is a retrace back to the original breakout point. But I do anticipate this to move higher. And one of the reasons I anticipate this to move higher, along with the US dollar, you can see the US dollar is taking a small break right now. It has run into its double top resistance, but this is the intermediate double top cycle. You have the major double top cycle, which goes all the way back to here in essentially the year 2000. So in my opinion, I think the US dollar will consolidate and move sideways for now, but I do think it does favor a potential breakout, which is going to put a tremendous amount of pressure on all global equities. So for now, I think we have a short-term cycle top, say for the next couple weeks, but I do think as the Fed continues to tighten that this will break out. And one of the reasons that I think this will break out, the US dollar, is when we look at the same monthly chart of the DXY, the only difference is we changed this. This is now the federal fund rates. On the previous chart, it was the US 10-year yield, so this is the bond market pricing in yields, and this is the actual central bank of the United States federal fund rate. So essentially, this chart demonstrates when the Fed raises interest rates, the dollar also strengthens, just like what we observed in this chart. And then secondly, when comparing the two charts, there's a clear lag between the Fed fund rate and the US 10-year. So look where the federal fund rate is. It's still trading below this downsloping trend line of resistance, whereas the bond market has priced in a Fed fund rate breaking out and going higher. So the bond market is always forward looking. And this chart will suggest that the Federal Reserve is severely behind the curve. It also suggests that they will continue to raise the Fed fund rate until something breaks. So essentially where the Fed fund rate is now and where it gets to this blue line of resistance, it's essentially another 100% increase in the federal fund rate. So that is still a substantial move in rates that it should continue. We have nowhere near reached the resistance level that I think is going to break something. So essentially, if the federal fund rate still has to push higher, this means the US 10-year yield will likely push higher, and therefore the US dollar will likely push higher. All of these scenarios are catalysts for the equity markets and the rest of the world. A strengthening dollar is going to eat up the Eurozone. It's going to eat up all the other G7 countries, and it's not a good thing for realistically anyone but the United States of America. So we'll have to continue to monitor these currencies. Gold, it all correlates in tandem, but I do think we have a good grasp of where the markets are likely to head based off of what the bond market's signaling, what gold is doing, what the currency markets are doing, and what the overall equities. But I still think that we have higher rates to come, and I think the Fed will raise rates until they break something. So that is kind of the takeaway from this video, is that we may have a short-term cool down in rates, but don't think they have topped. I think we will get a push higher. So that's it for today. I hope all this analysis helps. Congrats on all the profits that we've made this week and last week and overall in the whole year of 2022. Hopefully you all will enjoy the weekend, and we'll see you on Monday for the